What's going on, everybody? Jeff here. Welcome back to the channel. One of the lowest volume days of the year on the SPY, going all the way back to November 11th of last year, just ahead of the July CPI data set to be released tomorrow. Now, if you're taking a look at the charts and you remember what had happened 2 months ago when the June 10th release was made, we dropped about 50 to 60 points in just a matter of 5 days. We've had 8 days channeling back and forth between that 407 and 417 level. Just like we did from May 27th to June 9th, we are at a very big pivotal point. There's a couple similarities I see between the previous CPI releases as well as some differences. I want to talk about those. Then I also want to talk about AMC. It's down about $5 from where it was just a couple days ago. Now, when we originally got the news of the 8th dividend, we expected a little bit of a sell the news event, and instead we got a little bit of a rally. We are also kind of expecting a little bit of a run up into the dividend. I want to talk a little bit about where we stand from not only an options level and a technical level, but just from a big perceptive level. Okay, so let's get right into it. First off, let's talk about CPI. So everywhere in the media, the big sentiment is that, listen, inflation is showing signs of peaking. Okay, you can see I have highlighted right here, the report is expected to show a slight slowdown in inflation. And here's the thing, there's two numbers everybody needs to look at. It's month over month and year over year. And it's very easy for us to see month over month that gas prices have declined, diesel prices have declined, which also help with the transportation of goods, as well as home prices. Now, shelter makes up the biggest percentage. And everywhere you look, it's talking about inflation peaking. So I want to talk about a couple numbers set to be released. So the consensus is for Wednesday's July CPI report to show an increase of plus 2% month over month and 8.7% year over year. That's your headline number. That's that top number. Now, last month it was 9.1%. So showing an 8.7% would be a little bit of a decrease. However, in the contrary, the core CPI, which is everything except for food and energy, is expected to show a 0.5% month over month and a total of a 6.1% year over year. So that 6.1% is going to be higher than the 5.9. My opinion is they're going to be looking closer at the month over month. Okay, they know that, and this is completely my opinion, just a feeling I'm getting in the sentiment and what I'm reading and how I'm literally just watching the market move based on their reactions, right? Because everything in the market is generally priced in. However, some things can also be reactive. Okay, so we know that, listen, inflation is going to hang around above that 3-4% for years to come. However, are we seeing a bit of a peak? All right, they're hanging on to it, any little bit of hope that we are seeing a bit of a peak. And I think they're really going to bite onto this. Now, if you take a look at the chart, and I'll zoom in just a little bit right here, you can see going back to May 27th, all the way up to the 9th. Okay, there's 8 days we were kind of just bouncing back and forth between this range. All right, and once that CPI came out, which was a big surprise, we fell all the way from that 407, all right, even leading up to that 401, all the way down to 362. We're bouncing around a little bit, slowly recovering, and then here we are coming up for the end of July the 29th, and here we are just channeling right back in between the same points. So when looking at this chart, getting a bit of a feel, one would think, listen, if inflation comes in showing any signs of a peak, any signs of just slowing down, any signs that, listen, this might not be, good, this might not be great, however, it isn't continuously getting worse, we might see a move to the upside. But here's a little bit of the contrary. And I was talking about this with a couple of members inside the group. This is the VIX, and this is the Fear and Volatility Index. And we didn't really see a bit of a spike coming into today. It was up just about 2.3%, which tells me two things. Okay, the first thing clearly is that investors are not overly worried about inflation. The other thing it tells me is, listen, if we get a big surprise, it's clearly not priced in. So as you can see right here, I have these white arrows. Now, these white arrows are the dates that CPI has been released for the entire year. And going back all the way till February, March, and even April's release, inflation really wasn't starting to become a severe issue until around that April, May area. And you can see all the way up in May, the VIX was over 30. even in June, when we got that big surprise, the VIX was all about that 26 and a half, 27. And clearly we saw that massive spike all the way up to 34. Coming back to last month, we were still around that 28, 29. And here we are sitting just above 21, 21.79. Like I said, it goes back to the two things. If, investors are just listen, like if there's any bit of signs of peak, it's going to be full to throttle. There's plenty of money on the sidelines. We're coming off of very low volume. However, in the contrary, okay, and this is why we try to, always wait and let price action dictate the direction that we're going to take. There could be a massive surprise. Now, there's all bit of speculation going on around right now. Have we hit the bottom? Are we going to continue to move to the upside? All right, are we going to break that 362? When looking at, a macro perspective, and taking account, economics, fundamentals, okay, where just where everything stands with inflation, the Federal Reserve, the federal deficit, the continuous spending we have, I can still see more downside when you're looking at price earnings ratios. And you see that some of the bigger companies like Apple sitting at that, 165 level, which is not far from where they were, at their all-time highs just a short time ago. It's those big mega cap companies really carrying the entire market. You look at where Tesla is sitting at 850. They're really carrying the market, holding it up to where it is. Plenty of room to the downside. It looks like growth's found a little bit of a bottom. Growth is always the first one to sell off. So keep that coming into mind tomorrow. Those are the two things I have, is that listen, if it's a bit of a surprise, the reaction is going to be strong. If it's in line, we might be able to get above that, that 417.5 level that we've been fighting with for quite some time. We get into a little bit more of a blue ocean. Like I said, it is some of those bigger companies. Now let's talk about AMC, okay? And we find out here. So a couple things I do want to point out. I'm going to go to this 10-day, 15-minute chart. So generally speaking, when there is something, now obviously we did fall into something that's a little bit different, okay, when it's a preferred equity dividend, different than a split dividend, okay, split via dividend, I should say. However, you have to try to see what has been shown to the market before and how did it react. Well, a lot of times when you do get that, it is a sell the news event, which clearly after hours we did get that. However, the following day was not typical. We got a massive run up. It continued a little bit into the morning. Of course, you see this massive wick right at open where it's shorts piling into positions to take us down further. We've seen this, with many small caps, okay, before. But generally, you see a little bit of a sell the news event. Then when you get closer to the dates, which the 3 dates we have in mind are the 15th, the 19th, and the 22nd, we get a little bit of a run up, okay, into that, and then clearly another little sell the news event. And that hasn't played out, all right? And as you can see here, normally it is a sell the news event. We got that massive rally to the upside. There's a couple things that take into effect, and I really like to focus on the options chain because I've seen market maker manipulation when it comes to price action, but it's much more profitable and it's on a much bigger scale when it comes to manipulating the options. And when you take a look at just, the open interest, let me look at the overall open interest. The call to put ratio is sitting at about 72.28. It was actually a little bit higher earlier on the day and even higher yesterday, sitting about a 75%, 76% to 24%. And when you look at the amount of open interest, this is just for the 12th. Okay, the amount of open interest that's still open on these, these 25s, there's 30s. You look all the way into the 40s. We're sitting at 25,000 contracts. Okay, it's very apparent that the market makers will continue to just kind of toy with this level until it gets that big, massive push, until that big, heavy volume comes in. Now, you have to remember back in June and in May of last year that, it was really the massive flow that got us to push to this next level. And I haven't showed this chart in quite some time. All right, looking at where the institutions stand, and you can clearly see that, as Q2 of 2022, the 13F filings are, set to the 45-day requirement is coming up in just a few days. You can clearly see that funds, besides after that massive run up, are really just hanging on. They're not really adding to their positions. Obviously, they're, some small scale, 19 million, which in the realm of things is very small. They're not really adding to their positions, but they're clearly not selling and getting rid of it. But when you look at the massive run up, it was the big money that overpowered, and we're not getting that overpower. And therefore, it's literally just market makers playing with your emotions. Okay, that's what they're designed to do. They're reading, retail sentiment. They're reading order flow. They're pinning the prices where they want it to be in order to be able to, attract the amount of flow. pin the price to where it is and to be able to collect those premiums. All right. When you look at Stocko Tracker, just to give an overall, view, there is a lot of options that are in the money, especially for the monthly time frame. And I think this 19th date had a lot of, those 15, I have $16 calls that I've been holding for actually all the way since, back in July. It's a little bit different time frame, and you still see there is a good amount of in the money, still a lot of out of the money for the 12th. It clearly outweighs the puts. All right, when you're looking at this, it's about a 2.5 to 1, maybe 2.3 to 1. All right, and clearly this is almost a 5.5 to 1 ratio of out of the money in the money. So it is a much more of a call flow, but just to keep that in mind. So when you are looking at this intraday price action, and when you're looking at out of a smaller time frame, listen, the difference between 22, 27, especially when some price targets are much higher, when 72 is the all-time high, it is a very small value. All right, and even just looking at these massive wicks, and you can go even to a smaller time frame such as the 5-minute. When you see these wicks, this is pure market maker manipulation, toying with the price action in order to be able to pin it to where they want it to be to attract order flow when it comes to the option. Now, when we're looking at this larger time frame, I will bring the study back up for you because I know I pulled it away. We're still above the 200-day moving average, which was a break that we haven't held above since all the way back since we had the run up in 2021. Once we broke below that in November, we kind of tested it, had a little bit of rejection. Clearly, all the way back at the end of March, we had the same rejection, and we're holding over that. Now that 22 is a bigger level. As we just saw right here, you can see it, that 22 has been a bigger level of support. Clearly 20 is a psychological level, but you can see where that 200-day moving average is on the daily time frame. So just keep that in mind, especially when you're watching the price action. Seems like the chart just plays out very similar, especially over the past few months when you see the massive spikes leading into pretty much just a shooting star leading into a bit of a downfall. So I had said look at this for a bit of a just a pattern recognition. I was hoping that we would get a little bit of a less of a spike than we did, and that we would see more of this kind of lead up to, which is what we saw, then consolidation and then a rip. But when we get those massive rips to the upside with no consolidation, that's when it leaves that shooting star and just room to continue to go to the downside. So from the bigger perspective, like I said, price action is kind of just pinging back and forth. And when difference between 27, 25, it's really just messing with your emotions. So guys, that's it for this video. I'll see you in the next one.